Let's shift focus now and go over to discussing corporate earnings. The Escorts stock has risen after posting earnings which were better than estimates. They were led largely by the tractor business. The construction equipment and railway verticals have also done well this time around. Bharat Madan, the CFO of Escorts, joins us now. Good morning, Mr. Madan. Thank you very much for joining us. The results were operationally better than expected. EBITDA was better than expected. Can you tell us what went right?
Well, I think this time, obviously, the industry has done pretty well. So I think the most of the growth which has been coming is coming basically from the volume. So which is what is, I think, playing on the operating leverage side. And obviously, to some extent, there was some pressure on the cost side too, because of the inflation coming in. Otherwise, probably the margin could have been even better if you look at like the Q4 margin which we had. So we missed some numbers there in terms of the tractor business margin, which we were expecting could be close to 15% plus. But this time, so there was a pressure on inflation and some mixed issues. So we actually missed some of the guidance on that front.
So will you be passing on the raw material costs to consumers in the form of price hikes in the months to come?
Yeah, so we already done that. So I think we had done some price increase in the first quarter also, which was roughly 50% of the inflationary trend which we faced on the commodity side. The balance we had passed on in July. So hopefully this quarter will not see that effect really coming from inflation.
Okay, so you hold on to your guidance of the 100 basis points improvement in margins in FY19?
Yeah, so we still maintain that because all the business, if you look at, I think doing extremely well. So compared to last year, so I think our guidance on 100 basis point movement is intact even now.
The revenue from construction equipment, I know that's not your giant sector, it's a small sector, but it's fairly good. Do you think you will be doing 250 crores every quarter?
Well, I think this is one sector which can actually give us very positive surprises. I think the kind of growth we are seeing on the infrastructure space is huge. So, but yes, there can be some slowdown because as you move towards the election, closer to the election period, there may be some slowdown on the infra spending from the government side. This is largely driven by public spending. Okay. But generally, we're saying this sector can actually give us very positive surprises going forward.
That was going to be my question. Who is placing orders with you? It is largely government?
Yeah, so it's largely public spending based, like the road sector is doing extremely well. The mining is also picked up. So I think both the sectors are driving the demand.
What accounted for the improvement in railway equipment margins? Did you get more orders or is it more operational leverage?
I think in railways, essentially it was a combination of some better product mix this time because it basically depends on what order we execute. So order book size continues to be 300 crores plus as of end of June, which will get executed over next 10 to 11 months. But overall, I think this time we had pretty good mix and some good export orders which we got, which actually led to better margins in this segment this time.
Okay, so 300 crore plus order book just for the railway business is what you're talking about, right? What about the construction equipment business? What's the order book there?
Construction, we don't really maintain the order book, but it's more like a retail sale over there. So that's still, I think we expect the year will give us close to, I think, 20% plus growth in construction segment too.
Okay, so 20% plus growth in the construction segment. Also, these orders, incremental orders that you're getting in railways and construction, do they come with higher margins? Because we've seen this time the railway equipment business the margins have substantially improved. On an average, what kind of margins do you see there?
So I think, full year basis, we expect the margin will be close to 17-18% range in this business. But there are large new product orders which we have, which need to be executed in the balance of the year, where the margins will be slightly lower. There's a lot of import content still is there in those margins only will improve.
Sure. So 17-18% margins in the railway segment, right, is what you spoke about?
That's
okay.
That's right.
All right. And finally then, for the tractor business itself, wanted to understand from you, if you look at the margins for the tractor business, this 14.1% that you've seen, you did mention to us that this time around there's been a slight dip because you couldn't pass on the entire raw material cost. But on an average basis, what kind of tractor margins do you hope to clock in for the rest of the fiscal?
So I think this year we're expecting we should be able to be somewhere around 14.5 to 15% operating margin range for tractor business. So this quarter has been pretty close to that. But next quarter Q2 we expect may not be as good because the volumes will not be really as bullish as we had seen in the past 2-3 quarters because the GST transition issue. But Q3 we expect again will more than make up only for the shortfall in Q2. So overall full year we expect will be around 14.5 to 15%.
Okay, and you hold on to this 9 to 11% industry growth target for the full year?
So actually we are revising it upwards now. So we're looking at the growth what we've seen. So we expect probably the industry should give anywhere between 12 to 15% now growth for this full year.
All right, that's good to hear. So upping the industry targets as well. Bharat Madan, thank you very much for joining us. And that's a fairly bullish comment. Key takeaways?
Yes, it is. That's actually the most important comment. For the last many months, they held on to a 9 to 11% industry growth for FY19. And now they're revising it upwards to 12 to 15%. So I think the entire sector, not just Escorts, but M&M could also react positively to that.
All right. Well, on that positive note, actually a positive note on the markets as well. The dip has been shallow, at least as of now. And we will call our technical experts in just a bit. For the moment, we take a break. We are